These are the Simplify Barrier Income ETFs. Simplify Barrier Income ETF, ticker symbol SBAR, and Simplify Target 15 Distribution ETF, ticker symbol XV. In this video, we'll discuss what are barrier funds, how SBAR and XV are managed, and portfolio implementation. Barrier funds sell a specialized put option called a barrier option. Barrier options only lose money at expiration if the underlying asset price drops below a predetermined level called a barrier. Let's look at how a traditional barrier option works. We'll look at an example using an option with a 30% downside barrier. Step 1 is for the investor to sell a specialized barrier put option. In exchange, the investor receives cash called a premium. The ideal outcome is for the option to eventually expire worthless. The premiums received are therefore the investor's profit. At expiration, there is no realized loss or gain on the option, provided the underlying asset price declines less than the 30% downside barrier. If the underlying asset price breaks below the barrier at expiration, the investor is fully exposed to the downside of that asset. It's important to remember that the downside barrier is effective as of the expiration date. In the interim period before expiration, the option value will fluctuate as the options get marked to current market prices. If the underlying asset return is below the 30% barrier at expiration, the barrier option seller suffers the same loss as the underlying asset. However, they will have a higher total return as income received from selling the option will offset some of the loss. If the asset return is negative but above the barrier level, the option seller will suffer no loss at all, and the premiums received are pure profit. If the asset has a large positive return, the option seller will not participate in upside gains. Their return is limited to the option premiums they received. So the barrier option seller's return is roughly the same regardless of the underlying asset returns, provided its return is above the barrier. That was how a traditional barrier option works. Now let's take a look at the specialized options utilized by SBAR and XV. SBAR and XV's barrier options have two unique features: worst of and callability. Worst of means that the barrier level is based on the worst performing of three underlying reference assets: U.S. large cap stocks, U.S. small cap stocks, and U.S. growth stocks. The reference asset can be based on an index return or an ETF that represents the index. Callability means the option is automatically called on a monthly basis if all three reference assets have a positive return. If called, a new barrier option is initiated to replace it. Worst of and callability are the key features that have potential to create a higher level of income than traditional barrier options. Here's the structure of SBAR and XV. They each sell a laddered portfolio of 1 year to expiration barrier options. Laddering reduces timing risk that can occur if only a single 12-month option were sold. Income from option premiums is paid out to shareholders as monthly distributions. The options are automatically rolled into new options upon expiration or when called. This means that the ETFs themselves do not expire, and there is no need to roll them into new product vintages. They can be held as permanent buy and hold positions. Comparing a traditional barrier product to SBAR and XV, traditional barrier products are offered as a specific vintage. For example, May 2025 through April 2026. New investors have to decide which vintage to purchase and what to do with their assets when that vintage matures. SBAR and XV are laddered products that are continually rolled making it more convenient for investors who simply want to buy and hold. Liquidity on traditional barrier products may be limited to certain redemption windows and may be subject to liquidation fees, while SBAR and XV are ETFs that trade continually throughout each trading day. Traditional barrier products are credit obligations of an issuing bank, making investors subject to the default risk of that bank. SBAR and XV are registered investment companies taking on minimal credit risk. Many bank-sold barrier structured notes issue the cumbersome K-1 tax form, while SBAR and XV issue simpler 1099 tax forms. Finally, many traditional barrier products have higher associated fees than what can be found in ETFs like SBAR and XV. So how does SBAR differ from XV? First, it's important to note the relationship between the barrier, risk, and income. The deeper the barrier, the lower the risk and income. As the barrier becomes shallower, the risk increases, as does the potential income. SBAR sets its barrier at 30%. It does not have a distribution target. Distributions will depend upon the market pricing of the options associated with the 30% barrier. XV takes the opposite approach. It has a target distribution of 15%. The barrier level is the variable that is determined by the market price for options that can produce a 15% distribution. XV will have a higher distribution than SBAR, with a shallower barrier and thus a higher level of risk. So the decision between SBAR and XV simply comes down to the investor's risk and return preferences. Let's briefly discuss portfolio implementation. SBAR and XV have three primary use cases. First is income, which will typically be significantly higher than what is available in most fixed income products. SBAR and XV can also be used as a way of mitigating equity risk due to the embedded barrier at the option expiration, as well as the income which can offset losses. Lastly, the use of barrier options adds a differentiated set of return drivers that can increase the diversification of a portfolio. Sourcing an allocation to SBAR or XV depends on the investor's goals. In many cases, SBAR and XV can have lower risk than stocks due to the barrier. However, they are riskier than bonds, so sourcing an allocation from both stocks and bonds can result in a relatively neutral portfolio risk profile, although one with increased income and diversification benefits. Sourcing from stocks will make a portfolio less aggressive, while sourcing from bonds will make a portfolio more aggressive. Now for some Q&A. Suppose stock prices are declining. Will the fund's share prices remain stable as long as the worst of asset decline is above the barrier? No. As the reference assets decline, the share prices of SBAR and XV will also decline as the value of the options is continually marked to current market prices. However, as the options approach expiration, if the reference assets remain above the barrier, the fund's share prices will increase, eventually eliminating the loss. At expiration, the net effect to the funds will be zero, so the distributions received are the shareholders' profit. Keep in mind this illustration is for a single barrier option, and SBAR and XV will hold a laddered portfolio of options. Each individual option will follow its own unique path depending on timing. What happens when the option gets called? The barrier put option will be replaced with a new option. The barrier is reset to a new level, 30% for SBAR and variable for XV, and the 12-month time to expiration begins. No action is required by fund shareholders. What is the difference between barrier funds and buffer funds? Buffers are non-contingent. The buffer will always be in place regardless of the performance of the underlying asset. So if the underlying asset is down 30% and the buffer is 20%, the fund will be down 10% at expiration. Any benefit from the barrier is contingent upon the underlying asset remaining above the barrier. If it drops below the barrier, the fund is fully exposed to the downside. So if stocks are down 30% and the barrier is 20%, then the fund declines by the full 30%. The contingent nature of the barrier is why a fund with a 20% barrier will have higher income than a fund with a 20% buffer. What are the best or worst environments for SBAR and XV? On an absolute basis, the worst return will be when the worst of asset return drops below the barrier at expiration. The absolute best returns will be when the worst of asset return remains above the barrier at expiration. On a relative basis versus a regular equity fund, the worst environment will be when stocks have a very strong year above the amount of premiums earned. The best relative performance will be when equities are down a large amount, but just above the barrier. In that case, there could be a dramatic difference in returns in favor of SBAR and XV. Thank you for viewing this presentation. For more information about these or any other Simplify ETF, please go to simplify.us/ETFs. We'd like to hear from you, so if you click the Contact Us link at the top of the page, you can get in touch with us and we will respond promptly.